Silver isn't just rising, it's breaking a 50-year pressure cap, and the next spark may come from bonds. That's the market most people ignore, and the clock is speeding up. If you only stare at silver, you'll miss the trigger that turns a climb into a launch. When bonds shake, everything gets repriced. That's where the shock begins. It's Wednesday, January 21st, 2026. Silver hovers near $94 and steals the spotlight. But 30-year Treasury futures are clinging to a ledge. Drop a few points, and that ledge can turn into forced selling. In that moment, silver doesn't drift upward, it snaps higher. Quick note before we sprint. This is education, not personal financial advice. Use it to build a playbook and manage risk. If you want early signals like this, hit like and subscribe right now. It trains the algorithm to send you analysis, not hype. Turn on notifications too, because catalysts don't schedule themselves. The move you plan to catch later often happens now. Here's the missing dimension. Bonds are the gravity of finance. Yields pull on every asset through rates and spreads. That's why bond charts lead. Stock valuations start with the risk-free rate, then build from there. Mortgages, corporate debt, and hedges all lean on treasuries. So a long bond break isn't a tech bubble story. It's the foundation wobbling under the whole system. Long-duration bonds have been hammered since 2020, and rebounds have been fragile. That's crucial because duration amplifies damage. Think of it as a spring. A 30-year bond can lose big on small yield moves. It's safe in credit, but volatile in price. Michael Oliver calls treasuries the beast. Central banks can't let fail, not for pride, because treasuries are collateral. Repo, margin, bank liquidity, derivatives. Treasuries sit in the plumbing. If plumbing clogs, markets choke fast. When it breaks, spreads widen. Technically, markets often get 3 chances to turn before they break. When rallies fail again and again, the fourth move often snaps. You see the same bounce zones, then rollovers that crush hope. Each failure attracts sellers with tighter risk. Support isn't just a line, it's a shared belief. When that belief breaks, sellers hit it once. The violence comes from mechanics, not mood. Losses trigger models, models trigger cuts, and cuts create more selling. Algorithms do it in seconds. Yields jump, volatility spikes, and balanced portfolios suddenly aren't balanced. That's when safe assets start acting unsafe. Silver matters here because it's money-like and industry-hungry at the same time. In stress, it can become an escape valve. Silver is tiny compared to bonds, so rotations hit harder. A small flow out of big markets can overwhelm silver supply, especially when inventories are tight. That's how timelines compress. A move expected over months can get pulled into weeks. Here's the setup. If 30-year futures break the low 110s and hold, momentum systems can flip together. That's your mini panic zone. And the selling can cascade. Panic doesn't look like a slow leak. It looks like gaps in acceleration. You'll recognize it by speed more than by headlines. Watch for yields spiking in 1 or 2 sessions, not grinding for weeks. Fast spikes are forced selling and rushed hedging. Then comes the policy response. Officials talk about liquidity and market functioning when they're building a backstop. Listen for those phrases. That can mean bigger repo ops, new facilities, or outright buying. The goal is to stop a chain reaction. But intervention can freeze volatility without fixing the cause. Prices can go sideways, tight and unnatural. Dead ranges often mean a large buyer is absorbing selling quietly. It's a pause, not a cure. If bonds weaken again after that pause, confidence doesn't reset. It fractures. Fractured confidence feeds precious metals. Metals, history rhymes. Late 1970s confidence broke, inflation fear rose, and silver turned into momentum. The last leg arrived fast. Gold often moves first, silver later. That surge was bursts and pauses, not a smooth ramp. When it went vertical, it surprised even believers. 2010, 2011 showed a similar rhythm. Base, fake out, then explosion. The midpoint shakeout was the trap. Big moves usually include a scary reset that looks like the top. It's the market testing conviction. So the key question isn't, will there be a pullback? It's, where will it happen, and will you misread it? If bonds crack first, silver can sprint toward $120, $130 before the stumble. If bonds hold longer, silver may grind toward $100 first. Same destination, different path. Stairs or elevator, both can reach the same floor. Add a second accelerant, policy uncertainty. Trade fights and tariff headlines can inflate risk premiums overnight. If investors sense global trade is less predictable, they demand more yield. Higher yields push bond prices down and tighten the loop. That's term premium rising. There's also supply. Big deficits mean big issuance, and issuance needs buyers. If demand softens, term premiums rise. Auctions become the scoreboard. Foreign buyers also matter when hedging costs change. If hedging gets pricey, overseas demand can cool. When demand cools at the margin, this market reprices quickly. Small percentage shifts are huge dollars. So what should you watch day to day? Let's turn this into a simple scoreboard. because being right and late feels awful. The goal is to spot a change in character before the crowd does. Block 2. Number 1, the long bond break. Look for a break and close below the prior low zone, not a quick dip. It's a crowd vote on safety. If it holds for more than a session and volatility expands, stress is real. Speed plus follow-through is the tell. Number 2, yields with ugly context. Yields jumping while stocks wobble and spreads widen is a classic risk-off mix. That combo pressures every balance sheet. In calm, yields rise on growth. In stress, yields rise on missing buyers. Fear language will dominate the tape. Number 3, silver's daily range. Acceleration shows big up days, strong closes, and dips that get bought fast. If silver starts printing $5, $10 days on volume, that's not normal. That's urgency. Number 4, the gold-silver ratio. A fast drop toward the 40s signals silver is winning the race. Slow moves are typical, fast moves are information. It means buyers are choosing silver, not just hedging. Number 5, miners decouple. When miners rise on down stock days, money is treating them differently. It's not perfect, but it's a strong clue. Watch breadth across miners, not one name. 2 bonus tells: repo stress and funding jitters. Overnight rates jumping can precede bigger volatility. It's the plumbing talking. Also watch the dollar's behavior. It can surge on cash demand or slip on confidence, and both can shake metals. Silver can outrun your brain because positioning is leveraged. Futures and options magnify moves, and margin calls magnify exits. Leverage cuts both ways. When volatility rises, margin requirements often rise too. That creates violent bursts and sudden shakeouts. That's the lightning event in plain English. Thin market, urgent buyers, crowded shorts, and forced cover. Covering becomes gasoline. How can silver jump $20, $30 quickly? Price is set at the margin by the next trade, not the average cost. When sellers step back and buyers chase, price resets in hours. Physical supply then lags, often with premiums. That lag adds feedback. Tight supply stories pull in more buyers. More buyers push price, and the loop can repeat. Now the midpoint stumble. It often hits right after the move feels obvious. That's when confidence becomes complacency. It feels personal, but it's math. It can be a sharp 2-week drop or a boring sideways grind. Either one can shake out weak hands. The antidote is planning before adrenaline. Decide what would make you hold, add, or step aside. Many people use tranches, smaller size, or no leverage. The goal is survival through volatility. If you use miners, remember their businesses. Costs, politics, and management can matter as much as metal price. That's why miners can soar and whip at the same time. They add torque. Back to bonds, because this is the catalyst core. When long bonds fall, duration hedgers often sell more to stay hedged. It's forced hedging, not opinion. That convexity loop can accelerate declines. Loops are where calm turns into shock. If policymakers step in, markets can calm temporarily. That calm can trigger the metal pullback everyone misreads. A soothing headline can cool fear and pull silver down 20-30% from a spike. Then debt and issuance pull the trend back. So focus on regimes, not perfect predictions. Calm, stress, intervention, aftershock, each has a different feel. In calm, silver consolidates. In stress, it gaps. In intervention, it whips. In aftershock, it can launch again. Now the hard part, psychology. Silver at $94 feels late, only if you anchor to old prices. Your brain wants comfort. Markets don't price nostalgia. They price today's balance of trust and scarcity. New regimes make old anchors useless. Waiting for certainty is expensive. By the time it feels safe, volatility is usually highest. The crowd arrives when narratives get loud and charts look vertical. That's the worst time to improvise. Think in 3 phases: disbelief, acceleration, mania. Most gains come before mania is obvious. Mania is when neighbors ask about silver and commentators discover it. That's when risk control matters most. Right now, signals are flashing while mainstream skepticism lingers. That gap between signal and attention is the window. That's the setup. So what do you do today? Build your watch list and define your triggers for a bond break. Because if the long bond cracks, you won't get a slow warning. You'll get a fast move and messy tape, volatility clusters, track the support band, the speed of yields, and silver's daily range. When they shift together, the message is loud. Remember, trends don't pay you for being correct online. They pay you for discipline through the shakeouts. The next few months may not be smooth, but they can be historic. A staircase can become an elevator. Stay focused, stay flexible, and don't confuse a scary dip with a broken thesis. In fast markets, dips can become launch pads. The pieces are moving even when it looks quiet. Subscribe now, and I'll walk you through the next shift the moment it appears.